Do you hate the thought of working past 55 or 60? Do you hate not being able to live the life you deserve today? Do you hate not knowing what your financial future looks like? It's time to stop doing what you hate. Here's your host, Mr. Harold Green.
There's a strange thing that happens when you get close to retirement. It's interesting. The financial world suddenly gets very loud. It's all you can think about is your retirement account. And suddenly everyone, every bank, every brokerage, every talking head on TV, they all have an opinion about what you should do next. Where should you invest? What opportunities you shouldn't miss? What risks you should ignore? And the interesting thing is, the louder the noise becomes, the harder it is to hear the one voice that actually matters the most, your own. And most people don't realize this noise is not advice. It's propaganda, and it's engineered messaging, and it's designed to influence your behavior at the exact moment your money is most vulnerable. It's insane. So welcome back to Stop Doing What You Hate, How to Win the Retirement Game. I'm your host, Harold Green of Bright Tree Wealth Management. And this is episode 4 of our series, Financial Advice versus Financial Propaganda, the series where we break down industry myths and build real strategies that help you win the retirement game with clarity and confidence. So are you ready? 1, 2, 3, let's get it. Today, what we're going to be doing is we're going to be pulling back the curtain on one of the most powerful storytelling machines in the world, Wall Street. And I'm going to get into something here real quick. It's the hidden incentive system. And here's what you need to know. Wall Street does not make money when you stay calm. Wall Street makes money when you take action. Activity equals fees. Turnover equals revenue. And then emotion equals opportunity. I can't tell you how much money we've made for our clients off the CNN Fear and Greed Index. I can't tell you. It's insane. Almost every narrative the industry pushes, it's like optimism, excitement, urgency. It's all designed to encourage one thing. That's movement. Like movement. This is why almost every analyst rating, it's a buy. And this is why market strategies rarely forecast declines. And this is why financial media thrives on drama. No, I won't say they rarely forecast declines, because some of them, you got the bulls versus the bears, and you'll have the bulls always forecasting upside, and you got the bulls that are always forecasting downside. To them, the market is always going to crash. Like, it's not a conspiracy, it's a business model. And I've talked to you folks about this before. Don't hate the game, get better at how to play it. Okay? Retirees become prime targets because of the following things. They have accumulated assets. They seek reassurance like, Harold, are we going to be okay? Are we going to be okay? Their time frame is compressed if they're following the traditional methods of investing. My clients, their time frame is 30 years. I don't care if you come in here when you're 50 or when you're 80. My time frame for your investment portfolios is 30 years. And the long-term bucket and the short-term bucket and the intermediate bucket, they have different time frames, but I'm talking about your long-term bucket is 30 years. Short-term is 5 years, intermediate is 5 to 10, and then long-term is 15 and above, that kind of thing. And the other thing is the emotional stakes are higher. And once you see the incentive structure clearly, you see the narratives for what they are, tools. They're just tools, not truth. Now, the power of the story plus case studies is what I'm going to talk about next. Markets, they're chaotic. You're talking about trillions of dollars and billions of decisions interacting in real time. And Wall Street simplifies this chaos into stories like this. Like AI, I won't say in stories. I would say more like headlines, right? That are designed to do certain things. Some of it can be true. Some of it can be straight up propaganda, but you got to know how to differentiate between the two. And I'll talk to you about that in a second. But you'll hear things like AI will transform everything. This is a once in a lifetime generation opportunity. Tech always wins. Energy super cycle is coming. And again, you have to understand like where the truth is in this from where the lie is. Do I think tech always wins? Tech always outpaces inflation. I can tell you that. It's been proven. But if someone's sitting there trying to make a case for, say, tech over financials or tech over consumer cyclical, tech over energy. You always see these headlines when they're pitting one sector against another, and that's dangerous. And narratives give emotional certainty, right? But they also distort reality. Consider these real analyst misses that I'm about to get into. So the first one is Tesla. This is a long time ago, and they had a target of $60 to $80, but the actual was 235 to 400 plus, and that miss was a 400% estimation. And when April of 2025 came around and everybody was having the tariff tantrum, I said, look, guys, look, this is an opportunity that you don't want to miss. I didn't say it's a once in a lifetime or, once in a generational opportunity. What I tell clients is you have about 5 of these opportunities in your investing lifetime to become a millionaire. Like there's about 5 of them. You might get lucky and get 6. It depends on how chaotic the machine can get. The more chaotic the machine can get, the more opportunity you have because it is simply true. Fear is what presents the opportunities because people are scared. Meta, Facebook, they had a target of 350 and at one point, and the actual what it did was 88. It was miss was 75% overestimation. Zoom, you got a 500 target on Zoom. The actual was less than like 100. So 80 to 85% collapse. It was insane. Peloton, you know the story, 140 target, actual was $15, 90% collapse. Disney, $200 target, the actual was 80. The miss was like 60% decline. PayPal, $300 target, the actual was $60, 80% decline. Nvidia, 140 to 180 is what they had on this guy. And the actual was $500 plus. That was a 200 to 300% underestimation. Our clients have millions in their portfolios right now because we got this right. We're going to get it right every single time, but no, but there was enough hints and clues that led us to our estimation of what it was going to do, and we put options on it. Now, one of the things I'll tell you, these aren't normal forecasting errors. They're systematic. And I'll get into this in a second, but one of the things you can look at is, was this just like them getting it wrong, or was it a case of like lemony snickets, like just bad luck, like a series of unfortunate events, right? One thing after the other, after the other, after the other, after the other. And COVID just kind of gave us that lemony snickets kind of situation where you wasn't sure what was going to happen next. And then we got into, the election, then we got into the Ukraine war. I mean, it was just bad, bad, bad. Now, if analysts truly had predictive skills, they wouldn't be analysts. They'd be billionaires running private funds. And this is the truth. That's what some of these guys do. They are billionaires running private funds because they can predict certain things in the market. But prediction isn't the job. The story is the job for a lot of these people. Okay. Let's talk about the retirement danger zone. Now, the retirement danger zone, the 10 years before and after retirement is when your portfolio becomes the most vulnerable. And the reason why this is when people are the most emotional. You're emotional, like, hey, I got 10 years before I retire. Harold, what should I be doing? They say I should be doing this, but I don't think that's true because I have all these goals and dreams. And then when you retire, you're like, oh, man, I just retired. I'm not getting that paycheck anymore. I don't have a pension. And all I have here is this 401k. And, I don't want to mess up and lose it. And here's the reason why your recovery window shrinks. Losses hurt more because time is short. And this is why I tell people stay the course. And when someone tells me about this kinds of stuff like, hey, I don't have much time to recover money. And I'm like, well, why are you saying that? And they said, well, normally the market takes like 5 to 10 years to recover. I'm like, no, it doesn't. Your strategy might take 5 to 10 years to recover losses in your, paper losses on your portfolio. They're paper losses. But the problem is if you materialize those losses into real losses by selling at the wrong time, buddy, you got a problem. Okay. And it's going to take you a long time to get that back based on your strategy. And I tell my clients, I said, you know what? Your portfolio is going to go up and down. The thing about it is it's not if or when, it's like how much and then how long is it going to take to make those paper losses up. And if I stay the course and believe in our theory and our strategy and not materialize those losses, you're back in 6 to 12 months. Sometimes it's a lot faster than that. And you may say, well, Harold, how can you say that? It's because we're on top of our game. We are on top of our game. I thank the Lord that we're professionals at this, right? You go watch a professional football team. Do you expect them to like be missing tackles and like, not being able to kick the field goal? The guy, he goes to kick the field goal and he kicks it into the back of the snapper. No, you don't expect that. Like, you expect either he's going to miss it left or miss it right, or he's going to make it. You don't expect that crazy stuff, right? So if you hire true professionals to manage your portfolio, this is what you should be getting. You should be getting recovery periods a lot sooner, because if they're taking advantage of the chaos in the market, you're good. Number two, withdrawals change the math. Selling during downturns locks in losses forever. You don't want to do that. Volatility becomes personal. It affects lifestyle, not just account balances. And this is the dangerous thing that I tell my clients about. Do not let this volatility get the best of you. Just let it disseminate like water off of a duck's back. Just let it roll off. It'll be okay. Just keep rolling, keep doing what you're doing. Go on vacation, hug the grandkids, take them out to the movies. Don't sit there and say, oh man, my balance is down 200K this month because, the volatility and I just can't, I can't go nowhere. And it's like, look, this is why you have separate buckets. Your 5-year bucket should have everything in there that affects your lifestyle, right? And if that bucket is not volatile and it's stable, giving you income every single month, why are you worried about something 5, 10 years down the road? We have no idea what it's going to be, but we're working towards that. And number four is behavioral mistakes. They amplify it. Fear plus FOMO becomes like even more dangerous. All right, getting in at the wrong time, getting out at the wrong time. And then Wall Street, they rarely highlight these risks because emphasizing the risk encourages caution, and caution reduces trading activity. Right? When you're cautious, you don't trade as much. You let the stew cook on the stove. You turn the temperature down, and then you stir it every so often. Every so often, you go stir the pot. You stir it and make sure it's not burning on the bottom. You're not there on high every 5 seconds stirring the pot. You're going to mess up your meal, man. And this is what it is. And part number 5, we're going to talk about building a narrative proof retirement plan. I would say you should build a thematic based retirement plan. And the themes in the plan could change from time to time. And so this theme, it could be, I would say you should have several themes in your portfolio, and all the themes should be supporting one another. So it can be like AI, energy, infrastructure. Once that, technology, energy, infrastructure, once you get that thing built out and it starts to work and generate the returns that you need, then you can rotate a little bit and say, okay, how much is left in tech? Maybe I want to go move to, say, pharmaceuticals or medical or healthcare, and then build some of that in there and start to, so your themes are going to ebb and flow, and they should support one another in one particular realm or the other. So for us, it's like, okay, AI technology, and then how's that going to help build out the rest of the market? How's it going to help the medical community? What are we looking at? Which companies stand to benefit the most? What are their time horizons for implementing this and generating positive cash flow off of AI? All these questions have to be answered, and the theme has to be put together properly and managed on a weekly basis or monthly basis, or sometimes even a daily basis, depending on what your goals are. And a retirement plan that stands strong even when the narrative shift requires 3 layers. Number one, structural protection. You need a liquidity buffer, the 2 to 5 year bucket, right? Diversified core portfolio. That would be across several different buckets. Now, your short-term bucket, it should be based on income. The intermediate bucket should be growth and maybe a little income, and the long-term bucket should be all gas and little cash and all gas, right? Now, you can, depending on what's happening in the market, you can take that up and down. You can say, okay, I'm 100% invested right now, or I may take that bucket down depending on how crazy it is in the world. I could take that bucket down to being 50% cash and then 50% growth. It just varies. And that's where your portfolio manager and your financial plan has to jive. And then you have your timeline allocation, rules-based withdrawals, right? And I say plan-based withdrawals, not rules-based withdrawals. I say plan-based withdrawals. I say plans-based. I changed that to plan-based because your plan should dictate what you take out and when you take it out. And you also should have emergency withdrawal opportunities there too, like say money there for emergencies. That should all be balanced in. And again, rebalancing discipline. So again, if your portfolio is actively managed, that's good. And layer number two, you got to have behavioral guardrails and predetermined review windows, say every 4 months, not like every time it goes down, you're calling, hey, what's going on? Like, hey, if you're managing it yourself, yeah, you got to be more active with it every day. But if someone else is doing it for you, you don't have to look at it every day. Okay. Rules for increasing and reducing risk, FOMO safeguards. I don't think any of my clients have like FOMO issues. I haven't had one person saying, why aren't you heavily invested in Bitcoin, when it was just like, why aren't you doing this? Like, my clients don't do that. They say, Harold, I trust you. You're going to have us in the right thing at the right time. Thank you very much. Concentration limits. This all depends. Sometimes if the opportunity is so great, I'm all in right there. I would say I'm all in for a period of time, not forever, but for a period of time. Because when we're looking at which companies are going to give us the greatest returns over the next 5 years, why would you be sitting around in something that doesn't have the same probability out of fear of losing money? Why would you do that? Like I said, you have 5 or maybe 6 chances in your lifetime. This is when you concentrate because the fear is so great. That's when you concentrate, when the fear is great. Like extreme fear on the fear and greed index at a 3. That's when I look at, okay, who's going to benefit the most from AI over the next 5 to 10 years? And we go concentrate there. And as soon as everybody comes around to their senses, boom, they're good. Layer 3, narrative immunity. You got to be very careful with this one. You got to recognize headlines are entertainment, forecasts are opinions, price targets are marketing in some cases, and hype is a profit model. And you stop letting Wall Street shape your decisions and start shaping them yourself, not the talking heads. And I want to talk to you about having the strategist mindset. A retirement strategist lives by one truth: markets unpredictable, but my plan doesn't have to be. My plan doesn't have to be predictable. We can say this is exactly what we want to do, when we want to do it, and then put together an investment thesis that will allow you to accomplish that. And the thesis is going to change. It's going to ebb. It's going to flow. But the returns, they ought to be in a range. And so for us, I'm shooting for 20% a year on my long-term bucket. I'm shooting for 15% a year on my intermediate bucket. And I'm shooting for 5 to 10% a year on my short-term bucket. And my short-term bucket, it has income strategies in there to make sure that we got all the money you need in that bucket for the next 5 years. So if the market goes down on paper, if your portfolio goes down on paper, if it takes the market 60 or 5 years to 60 months or 5 years to recover, we want to get you back in, say, 6 to 12. And it depends on how cooperative you are, okay? If you get shell shocked, there's nothing I can do for you. I'll just have to wish you the best, and we sell everything out and put it in cash and just wish you the best. Winning the retirement game is not about being the smartest. It's about being the most disciplined. And that's what it is. Your retirement succeeds because you're protecting against catastrophic mistakes. I try not to let my clients commit disastrous mistakes that we can't recover from. You avoid emotional decisions. That's very important. You separate stories from structure, and you follow rules and not reactions. In some cases, boring can be beautiful, but sometimes if your portfolio is too boring, you will run out of money. But a calm plan, a plan that's well balanced, it's designed well. It's like having a house that everything is designed the right way. The living room, how it flows. So the outside, it's just a joy to live in. And you want to have a financial plan that allows you to retire and enjoy life, not just retire and exist. You don't want to do that. And if you're listening and you're thinking, I want clarity instead of noise. I want stability. I want to know that somebody has my back and I don't have to worry about this. I have somebody that they got this, they got it under control, they communicate. I want a retirement plan engineered around my life and not Wall Street's incentives. And so for you folks, like if this is you, now's the time to take the right kind of action. You can visit my website, schedule a consultation, or send an email saying, hey, Harold, I want to talk about it. And let us build a retirement plan that's stable, resilient, and narrative proof. So thanks again for tuning in to the show. It's been a pleasure talking to you folks. And until next time, everybody, 1, 2, 3, let's get it.
This is thepodcastfactory.com.